So the big question is always going to be, when will the Chinese market recover? If you're like me, you own around 30% of your portfolio in these Chinese equities. We need this recovery to happen, man. The K-Web is still down from the all-time highs since February 2021, from like 102 down to around $29, $30. And this is gonna last maybe another couple, 2 to 3 years. But we're hoping of the Chinese market growth for the next 2 to 3 quarters is gonna be fantastic, as the government is doing everything in its power to kind of lift up the economy. They're doing rate cuts right now. They're actually trying to prop up the housing market. If you think about this, if they're allowing the banks to kind of lend out more money and put more stimulus into the economy, giving more people money to buy more things, helping all the damn residential mortgages to kind of climb back up, as remember last couple years that everyone was so worried about the housing crisis for China, and that kind of noise has been kind of calming down. So you can see a lot of the recovery things happening in Chinese favor, but there's still a lot of work to do, because man, just looking at the K-Web again, like Tencent, JD.com, Alibaba are all fundamental in the Chinese economy, and the demand for the consumer is just not there yet, as people are still coming off the COVID fears. Like, they don't want to spend their money. They're still holding their money so tight. So we can't see the Chinese market recover until people kind of start spending again. And that's what the government is trying to do, trying to influence the customers to kind of spend their money, get the domestic market back up in its feet. But the crazy thing about all of this is that people are so down on the Chinese market, but it still grew 4.5% for the first quarter of 2023. Compare that to the US market. The US market is only 2.2%, but everyone is so down on the Chinese market. It kind of doesn't make sense when you're seeing 4.5% growth compared to the US market of 2.2% GDP growth, but it doesn't matter at this point. It's all about sentiment in the Chinese market, which is insane, because we know that once that sentiment kind of changes, or once the Chinese news is just not in front of your face constantly, because when you realize that all of these US funds are just running away from Chinese equities, they're taking their money out, they're afraid. Remember, we have people like Warren Buffett telling you that he's selling TSM because of all the Chinese worries. He doesn't know what's going to happen in China. That's exactly how a lot of hedge fund managers are thinking right now. The same exact way. They are not willing to take any Chinese risk right now. So selling all of their equities, doesn't matter if it's Tencent or Alibaba, they're so worried. If you're not realizing what's happening in the market, you just have to look at this damn chart. These two charts are just going to change your mind on everything going on in the economy right now, which is putting it right in front of your face and just telling you that we just have to wait until the sentiment shifts, or we're just going to keep these forward PEs for Alibaba, JD.com, Tencent, all these amazing companies at these low rates, and we're just going to see earnings growth going to the future, which is going to propel the stock eventually. So Sophia posted this chart on Twitter. Look at the divergence in the Chinese market compared to the Korea Stock Exchange, the S&P, Taiwan Stock Exchange, and the Tokyo Stock Exchange. Look at where China is, man. The Hang Seng is all the way down to record lows. Man, it's insane where it's happening in the Chinese market. Look where it was in January and February. It was beating all of these markets. Tokyo all-time highs, Taiwan market all-time highs, S&P is right here, kind of in that kind of range. This is what's going on in the market. The Korea market right here, almost all-time highs. Japan is at a record high since 1989. It's never been this high. Everyone is leaving the Chinese market. They're taking all of their money out of China and putting all that money in any other Asian country. It doesn't matter at this point. We're gonna have to wait 3 to 4 years, in my opinion, because we cannot depend on multiple expansion or any of that. It's just going to be straight earnings growth with a low PE for the next 2 to 3 years, and maybe buying back shares, maybe giving us a dividend. That's what we're going to have to rely on as people who own Alibaba, JD, Tencent, if you own PDD, whatever you own, that's what you're gonna have to really rely on going forward. Here's another chart explaining the multiples compared to the US tech companies, the big tech companies. As you can see, the China big tech companies are trading at way lower multiples than all of the American companies. We see Alibaba, JD.com, Baidu, NetEase, PDD, Tencent, all on the bottom compared to Broadcom, Oracle. We even have Meta. We even have Alphabet, Salesforce, Apple, Microsoft, Nvidia. Middle one's actually kind of high, which is kind of surprising. And we have Amazon, but you can just kind of see the stark difference in what's happening in the market right now. The multiples are at all-time lows. As the US, the Tokyo markets are just going crazy. Even the German markets are going crazy. So you can just see the stark differences of what's happening in the economy right now. As Chinese equity holders, you just have to be patient and kind of just ride this out at this moment. But the patience is going to be the key thing, especially since we're seeing the US market take off and all these other markets take off. It's hard to just look at the Chinese market and be like, damn, man, we could be doing so good if the sentiment wasn't there. But guys, we just have to kind of stay strong and kind of ride this out for the next 2 to 3 years. Guys, what do you think about this video? Like it and subscribe.